Good morning and welcome to the second Changing ESG Landscape Quarterly Analyst Call of 2012. I'm Dan Sweeney, the Director of the Institute for Enterprise Ethics at the Daniels College of Business here on the University of Denver campus. These quarterly analyst calls are presented by CRD Analytics and MetaView Incorporated. We're broadcast live from the campus of the University of Denver at the Daniels College of Business. The calls are sponsored by Enablon, our technology partner, and we want to offer some special thanks to the CSR Wire and Aman Singh for their help as well. During the next hour, our co-host, Michael Muyot and Mark Serwinowski, will discuss how companies measure, manage, and communicate ESG performance to drive operational and financial performance. Michael Muyot is the president and founder of CRD Analytics, an acknowledged leader in sustainable investing, and designer of the SmartView 360 platform, which powers the major sustainability indices and rankings. Mark Serwinowski is founder and CEO of MetaView Incorporated, another recognized award-winning leader in sustainable development, and designer of the Sustainable Development Diagnostic Tools, which link sustainability and financial performance metrics. We also have a very special guest with us today, the Executive Director of the National Association for Environmental Management, Ms. Carol Neuvelt. Carol will share insights from NAEM's recent Green Metrics That Matter research project and will reflect on how environmental health and sustainability issues are managed inside corporations. Now I'll turn the program over to Mark and Michael.
Dan, thank you, and welcome to the QAC show, the Quarterly Analyst Call on Sustainable Development. Michael, good to be back.
Great to be here. Very excited. I think that we're really making strides and working all the kinks out, so look forward to a great show.
Broadcasting from the Cable Center at the University of Denver. This is our fourth Quarterly Analyst Call and our second live broadcast, so looking forward to sharing their perspective. So what we'd like to do today is just begin with a frame of what the show is about, the format, some of the content items, and set that up for a forward look about our discussions today. So Michael, as you know, there's really no shortage of indices, rankings, or programs around ESG reporting. And with that, we recognize that our community, this global community watching this show, represents largely two constituencies: corporations who are investing in sustainable development and the financial communities in the marketplace. So our objective here is just to create a narrative, to create that common language through which we can talk about how corporations are investing in performance, right? So let's look forward on that. A quick overview of the format of the show. We have three segments. We have news, analysis, and a Q&A. As Dan mentioned, we'll have a live contribution from Carol Singer.
Looking forward to that.
Absolutely. So very quickly, let's take our point of view on framing up the narrative here. Take a look at the definition we have. You hear a lot of different perspectives, and we look at sustainability, we look at sustainable development. We've taken a sense here in a meta framework, if you would, across all the industrial programs nationally and globally, and looking at what is sustainable development. Fundamentally, it's a business imperative for corporations to manage their economic, environmental, and social performance across their business model. Now, once they invest that, from a ROI perspective, it's how they steward their capital and human resources and talent across their organizations to innovate their business models and products, generating value creation for all stakeholders, not including employees, shareholders, stakeholders in the communities in which they invest.
Investors, NGOs, the list goes on, all stakeholders. So I'm excited about this meta definition. What I think is great is it's not only simple and almost in plain business speak, but it's actionable. So for investors, it allows them to help identify the companies that are actually walking the talk. So they're doing it, they're measuring it, they're performing it, and they're communicating it. And that's what we're going to talk about, the companies that are doing it all. So where are they on that high end of the operational maturity? And when we look at from the investor perspective, we want to look at competitive advantage. And at the end of the day, companies that are driving top-line revenue growth. They're being more efficient and productive, so now they're driving bottom-line growth, which is going to equal earnings per share and bigger profits. And at the end of the day, from my side of the desk, we're looking for alpha. So what are the companies that are going to outperform the index and their peer groups? So we're going to talk about this a lot throughout the whole show.
And absolutely, and representing the operational side of the gamut here, looking for alpha, you're looking for the story. What's that sustainability story?
Right.
Looking for those data points around momentum, where the investments are going in capital and resource investment at the business model and product level, and how the investors can take the long view.
So let's make sure that the audience knows how to join us and connect. So you've probably seen some of the Twitter activity. We're now on Facebook, LinkedIn, CSR Wire, YouTube channels, so you can watch the videos afterwards. But right now, today, you can join us in a live CSR Wire produced chat by using the hashtag #SDROI. So
fantastic. All right then. So with that framework and setup, let's jump into the first segment of the program here today and the news. We'd like to talk about some significant issues in development around global ESG performance, institutional frameworks, and some general news items. Michael, if you take the first.
Thank you, Mark. Well, I feel like April and May and June has been pretty intense, and I feel like almost coming off tour, going from New York to California to Chicago to wonderful St. Louis, where the GRI produced a nice event in conjunction with St. Louis University and the RCGA, which stands for the Regional Commerce Growth Association. And we were able to sit down with Mike Wallace, the U.S. Director, Focal Point, as well as Herman Mulder, who is the new chairman of the GRI. Their working groups are in full swing. You can go to the website to find out the progression on the GRI G4 guidelines and where they are. And if you go to the full screen graphic now on Rio Plus 20, GRI has a very big presence down there. You can download this along with an entire packet to find out exactly which panels the GRI will be speaking at, the events, the locations. Their entire executive staff is down there. So if you are going to be in Rio 20, which just kicked off yesterday in Brazil, I really encourage you to attend these events because the GRI has been making great strides in terms of their footprint here. And I think it started the Heartland Conference and really has a ripple effect throughout the entire U.S. Mark, what do you think about that?
Fantastic, Michael. It was a wonderful opportunity to sit down with Herman Mulder, the chairman of the GRI, in our discussions and regarding global adoption of the GRI framework, not only globally across the globe, but also here in the U.S. Now, shifting gears for a second, another development in the marketplace, another example of making common the ESG reporting framework activities between operators and the financial markets. The Sustainability Accounting Standards Board has been chartered to look at establishing materiality ESG issues that will be foundational to reporting on the 10K and the corporate SEC reports. Many may be familiar with the FASB, which is a Financial Accounting Standards Board, and their charter by the SEC is to establish the generally accepted accounting principles. So the SASB is the sister operator, if you will, in the market sense, and this is where materiality meets ESG in reporting and linking it back to the bottom line. So take a look at the structural connections point here. Now there are US-based companies, and there's also linkage in the framework for the model relative to the global international reporting framework, GRI as we mentioned, and of course in the rankings, as you mentioned earlier, Michael, there's the Global Initiative for Sustainability rankings. So SASB in its development protocol now is in schedule to launch the industry-specific working groups here the next month, and I believe they're also scheduled for a global launch September this year. All right, so Michael, back to you, please.
Well, SASB is, I think, going to be very interesting. And, as you can see from that jigsaw screen, there's a lot of moving parts, and we're involved in most of them. Full disclosure, we've just been invited to be on the advisory board for SASB, and we'll be participating in the industry work groups to be able to add both the voice for executives, as Mark's expertise, on the operational side, and then mine, which is the sustainable investing, and which would be a nice segue into the next news item, which is about mainstreaming sustainable investing. And you'll hear like the common statistics, which is about 1 in every $8 is invested by a professional asset manager using some type of ESG or SRI screening methodology. So again, ESG, environmental, social, and governance, SRI, which is socially responsible investing, where traditionally it would be negative screening. A lot more are using it as positive screening, as we talked about before, helping identify the companies that are going to be financially sustainable and are good stewards of all forms of capital, human capital, financial capital, and built capital. What I'm excited about this portion is these are 3 companies, Morgan Stanley, Smith Barney, BlackRock, and Bank of America, which are staple names in the Wall Street and the financial service community, and they've all taken big strides in making sustainability more investable. So Morgan Stanley Smith Barney recently announced that they launched a impact investing platform, which is going to allow all of their financial advisors to have access to this information to be able to make better long-term investment decisions for their clients. BlackRock, who was also at the GRI conference, has restated their commitment to use ESG analysis to be able to also make better investment decisions for the long run for their clients. And Bank of America made a pretty big and bold statement that they are going to re-up on their commitment to helping their clients, and they're going to be investing $50 billion in environmental initiatives over the next 10 years. So we're pretty excited about this because we really see it as the tipping point, because it's mainstream brick and mortar companies that are doing this in terms of real investment analysis. Mark, back to you.
That's an amazing confluence of market making, investment capital, and the confluence of companies investing in their operations to improve their performance. You mentioned earlier the human capital aspect, and a recent story that was daylighted by CNN regarding the Freedom Project, which is their initiative to focus on child trafficking and labor issues, human slavery here in the 21st century. There are some 30 million people globally under the slavery protocol, if you would. And here's an opportunity where this links to human capital, and you think about ESG reporting. This is a social performance indicator. So corporations who are looking at structurally how they report on GRI and social performance can look at operationally where the risk is in their labor protocols for human ethics and human standards and labor standards, and structurally how that links to labor supply chain. There's operational risk there in hand. So CNN, they led this story. They discussed also a specific protocol for the cocoa industry, which we'll take a deeper dive on in the analysis coming up shortly. All right, well, let's a wrap, if you would, on some of the major news items, Michael. I'd like to transition the segment here to the analysis stage. And with that, what we'd like to do, folks, on the show at this point is we have some major news items. We frame it up and we take a deeper dive, if you will, around the ESG, environment, social governance issues facing corporations. So with that, Michael?
How deep should we go?
Quite deep.
Okay.
All the way.
So this is two segments, right? Truth and performance, and connect the dots. So I'll take truth and performance first.
Absolutely.
And we'll dive in. So we're going to cover continue the sustainable investing side is look at some financial indexes, some regional rankings, and then some hot new mid-cap companies that are really driving the sustainable supply chain, the global clean energy markets. So our first one that we're going to look at would be the NASDAQ QCRD, which was recently reconstituted in May. And then we'll look at the Southeastern Corporate Sustainability Rankings, which just had their award ceremony down in Atlanta on May 1st. And then we will look at the Seacrest Global Clean Energy Index last. So let's do the NASDAQ. So every May and November, we reconstitute the index, and we've seen nice stability over time, that there's not a lot of companies coming in and out, which is really good to see. And the base year was 2009 with a base index value of 1,000, and it is now at 1,132. So when we talk about truth and performance, we're seeing nice, not only value, but also growth in this. So Mark, these are some of the top sustainability companies, right? IBM, Novartis, 3M, Unilever, like we would expect that. But from your perspective, you know that there's a lot of energy companies that are in there. There's Hess, there's Royal Dutch Shell, there's ExxonMobil, there's Barrick Gold, there's Goldcorp. I think we understand why they're in there, but from your perspective and working with a lot of these companies, maybe you could tell some of the audience members why big energy and material companies would be in a global sustainability index.
Absolutely, Michael. You know, we look at how corporations measure, manage, and communicate their sustainability performance, and that's premised on the ESG, the environment, social governance frameworks. You wonder why it would be somewhat perhaps counterintuitive that energy companies would be in the top index. It's a financial performance index, but it's also balanced on the operating performance. Now, we talk about oil and gas companies and sustainable development. There certainly are opportunities for them, and they demonstrate in practice for those companies who make the index and performance quartile, right? They look at the license to operate. Let's think about that for a second. Take a deep dive, connect some dots.
Right, what does that mean, license to operate?
What it means is if you're an oil and gas operator and you're developing globally, you're investing in the community to access natural resources, to harvest those in a production environment and bring them to market. Before the company begins its drilling process, they do an environmental and social impact assessment. That's foundational, table stakes, if you would, to establishing the regulatory compliance protocols as well as the operating permit, the license to operate. So when we talk about social license to operate, that's a foundational investment.
Right, right. And we're hearing more and more about that social license to operate. And with social media and the news and where we're talking about it,
Absolutely.
Everything comes to the forefront. And we're going to talk about that more in Connect the Dots.
And from the operational perspective, that's a fundamental operational excellence. They can prove performance on their capital and stewarding of resources. They're investing. They're realizing the return on that investment.
Right. So let's connect a little bit of the dots here. So our next index would be the Seacrest Global Clean Energy Index. Seacrest Investment Management is based out of New York, and it's some former executives from Morgan Stanley. They do an excellent job in terms of all assets under management, but we collaborated with them to create a Global Clean Energy Index back in May of 2009. They also have outperformance, so it started with a base index of 100 and is now at 149, so more truth in performance. Now, what I like about this index, not just the fact that I helped create it, I mean, because that's always good, but what I do like about it, coming from Wall Street, is that these are not pink sheet companies. These are companies that are actually listed on the New York Stock Exchange, the NASDAQ, the Toronto Stock Exchange. They have a market cap between 250 million and 10 billion. They have revenue, they have clients, they make things. They are part of the industrial background and supply chain that feeds into the NASDAQ index. So they make these companies more sustainable. So Mark, if you look at some of the recently added companies, we have Progressive Waste Solutions, LG Display, Entergis, Waste Connections, MCOR. These are companies in some hot new sectors in terms of waste management, LEDs, OLEDs, distribution and cleanup of hazardous and non-hazardous waste. Across all these different industry segments, what do you think is going to be maybe some of the hottest ones over the next 6 to 12 months?
I would follow the money, if you would, on the operating investments that companies are making today. Largely energy demand, energy efficiency programs, water performance, and likely clean power. Those are three major sectors where you'll see companies, and you follow the investments that the corporations who are taking that sustainable development imperative, they're investing in their business model to innovate. They're investing in energy demand consumption, operational efficiency improvements, the energy material waters aspects of their operating model itself.
Right, water, water, water. We hear a lot about water, but what about the negawatt? Energy efficiency, isn't that one of the most cost-effective ways to lower your footprint?
It is indeed. It's not only in the demand side of the operating itself, but it's also how the corporations themselves will partner with some of these innovative companies as well as the investor-owned utilities to think through generation. It's not just a one-way push, it's a smart grid investment. You'll see, as we see often, how corporations are investing to, say, go off the grid, but it's also essentially where the customer becomes the partner in generation with the utility, and that reduces operating costs and creates new financial investment opportunities for both parties.
Right, so in your experience with the utility industries, aren't these some of the companies that will help make them when we go into some new industrial revolution or we go into the new green economy, aren't these the practical companies that could make a utility or a big oil and gas more sustainable and actually infect their performance in a real way?
Absolutely. This is the foundation. This is where the capital is going in this somewhat staggering economy. You see the restart and the global growth opportunities. These are flagship companies to track.
Right. And I guess one last point, like you hear something like Solyndra, right? So it's like all this government money went into it, but it was really an idea, and it's out there making this product and then going to do it. What I like about these companies is they have the client demand. They're not building it and then looking for an audience. They actually have more demand than they can handle, and that's reflected in the P&L, the balance sheet, and the 10K. So it's practical.
It is foundational.
All right. So let's go to the last little piece here in Truth and Performance, which would be the Southeastern Corporate Sustainability Rankings, which covers the 6 Southeastern states. And we have the top winners for each one of the individual states. Let me just pull this up in front of me so I have it. For Alabama, it was Vulcan Material Company. Florida was Carnival. Georgia was UPS. The winner in North Carolina was Bank of America for the first time. South Carolina was Sunoco, and Tennessee was FedEx. So of note here is that UPS won for the second year in a row, but Coca-Cola was very close behind. We like competition, good for the investors, good for the consumers, good for everyone. UPS was a big winner, and we're going to talk a little bit more about why later on. But Mark, you had joined me not just in the event, but actually in the rankings. For the first time, MetaView and CRD Analytics collaborated to incorporate leading performance indicators, which we could talk about in terms of this new lens of sustainable development ROI. So why don't you tell the audience more about leading performance indicators and what we did here?
Sure, Michael, absolutely. It was interesting, the third year running for the Southeast ranking, the 6th geographic state model. And notable, first off, before leading indicators, is the foundational increase in reporting, some 200+% year over year, right?
That's right. There was a 250% increase in the number of companies that went from non-reporting and laggards to intermediate adopters, leaders, and champions, which is operational maturity,
Absolutely.
which they can only get from both reporting and performance.
Exactly, and this is where companies see the opportunity to tell their sustainability the story to their stakeholders in the marketplace. It drives demand on the customer side and drives their culture to look at the opportunities for investing in their business model. So many of the companies were premising their reporting on the GRI index and the indicator and the CRD Smart View model,
Right.
Which is premised on GRI. Now,
Which is lagging performance.
absolutely.
The results.
So, the lagging, and it's a look back. So we wanted to add in the dimension of leading. So if GRI is what to report on ESG-wise, leading indicators ask you how well are you stewarding your capital? Do you have a framework that's the 3D sustainability lens for how you use and view your business model across the enterprise? How do you structure the innovation process? What are your capabilities internally in your supply chain, across your value chain, structurally? Where are the risks and where are the opportunities? And how are your capital investments being played out or in your operating budgets to manage those investments? So that was a fundamental, and if I recall, it's 25% weight this year for those companies.
Correct. And it's a pretty painless process, and we developed it so they could fill it out in maybe 5 to 15 minutes. But it gives companies a chance to really start to tell their sustainability story
Right.
in a more in-depth way. So we've incorporated these qualitative factors that look at the sustainability framework, looks at the organization, looks at how well they're innovating, looks at their performance measurement, but not just a check the box, are they doing it, but how well are they doing it, and how well are they planning to do it down the road? And is this all tied into their strategy? You talk about what? The overarching
Right.
sustainable development strategy. Maybe you could elaborate on what the lens looks like for these companies, and a little bit more about the type of companies that we were both able to, I guess, evaluate, and what did it look like through that lens?
Absolutely. So you have the broad stroke, as Carol will come on later on and talk about the cross spectrum of industry. We have energy companies, we have commodities companies, we have consumer products and goods, we have apparel companies. So
It's companies that make stuff again.
Companies that make stuff.
And transport stuff.
But companies who consume energy, materials, and water to make that product.
A lot.
Yeah, and they'd link that energy, materials, water, that recipe for their business model, if you will, and tie that back to what they report on, environment, social, and governance. There's the platform for the investment. So where are those risks? Where are the opportunities? And how is the company measuring that value? Now, what we do see, what's interesting in talking to some of the companies like UPS, for instance, or Vulcan, is how they're investing their capital. And it's not just the energy efficiency programs we talked about earlier.
Right.
Those are happening. That's part of the mainstreaming of sustainability, right? But for the leaders who are being recognized, they're already looking at the next step, and that includes product differentiation around those investments on environmental attributes, looking at market share relative to a forecast of new revenue based on a extended product life cycle, or perhaps a new product that comes through innovation and ideation. Through that lens, they see the risks, they see the opportunities, and they marshal and steward the capital and resources accordingly.
Right. And as a predictive lens, I think the investment community is really going to appreciate this, because they're looking for more and better information so they can make better investment decisions. And would you agree that maybe a company like Mohawk Industries, that again is a material-based company, I think that they've been able to embody the sustainable development ROI, because, and we could talk about this, they have in a very short period of time drank the Kool-Aid, in my opinion. So it's not just in terms of putting out a nice report, but it's the actions and the policies that are put in place. So they actually have a chief sustainability officer. They actually have a subcommittee on their board that meets quarterly and gets reported up from the president and the CSO. So when we talk about, where are you, you want to find out where you are along the way, not after it already happened.
Absolutely. That's foundational to the investment. It's foundational to the reporting of the story, and it drives behavior internally, as well as we linked an operations story back to the financial markets, how that company's chartering its sustainable development journey.
So just to wrap up on that, would you agree that we're in our collaboration on the lagging and leading, that this is a future trend? Do you think we're too far ahead of the curve, or do you think other folks will also start to follow the same path?
Well, yes, it's going to be the future. We in our collaboration and True Transparency, many of you in CRD are collaborating to generate and develop the next generation NASDAQ Sustainability Index framework, inclusive of leading indicators. But one foundational aspect from the feedback loop we got from this particular survey instrument was that many companies said, wow, these leading indicators are driving us to think and answer the hard questions. We're looking at structural investment and where the company's going. It enables them to make the business case. For those EHS and sustainability leaders, the CSO at Mohawk, right? They're looking at, well, we have operational budgets this year. Where are the investments going long term? You know, and you think about where to position the business. Many of the bets you make capital-wise and investing and innovating the business model are not this quarter or next quarter, they're next year. So how do you establish the business case framework and ROI? And many of the companies said that leading indicator set enabled them to create the narrative to chart the business case internally and then link that with the numbers operationally, and it became an obvious decision point.
Right. I remember a couple of people saying that, actually saying, you know, it gives us a new perspective or a new lens to look at our own business, and it helps us in terms of our articulation, telling our story to, you know, our bosses and the, you know, the executive suite. So they seem pretty positive overall.
Absolutely. So we look forward to that.
Yeah, stay tuned. So let's go on to the next segment.
Absolutely. So let's move on to the Connect the Dots segment here. And one of the things that Michael and I love to do is, as you can tell perhaps, is just talk about how companies are measuring, managing, and communicating their sustainable development investments. Those stories that come out from the operating companies to the global markets and the financial communities. Through our collaboration with many of those companies, we'd like to share some of the deeper dive perspectives. And specifically, now that we've looked at the truth and performance on financial performance measurement, let's look at some of the operating aspects specific to environment, social, and governance, where the companies are now reporting, but then internally operationalizing those opportunities.
Right. So why don't we start with environmental? Everything is all connected, so we're really just going to use the ESG pillars as a starting point. So we'll use that as a starting point, and maybe piggybacking off the Southeastern rankings, you know, two companies that we thought were of extreme interest would be CocaCola and UPS. So CocaCola is the, you know, global brand, and while it is brown sugar water at its essence, it is the best brown sugar water out there. And they have
1.5 billion bottles per day?
1.5 billion. So it's not my opinion. They're selling their product, so there's huge demand for it. But they face enormous resource constraints, and, you know, to make all those 1.5 billion bottles, they must use a lot of water.
Well, fresh water is the foundational feedstock to their product. Let's look at that and understand what that means. So here's Coca-Cola with an enterprise operating footprint of many bottling companies globally. So they operate globally and locally. And with that water issue, they had some pushback from stakeholders in the communities.
A little bit.
But it's a supply-demand side. On the supply side, they had to ensure continuity of the water as a feedstock into their production facilities, right? So with the pushback, they need to partner with the local communities, and they've done a fantastic job of investing and partnering with those communities to look at risk analysis of water security, if you would, as a supply chain issue for the company itself. And that's been an investment. Their CEO's been talking about it. It's a great storyline for how the company has taken through that 3D lens of sustainable development, the economic, environmental, and social. They've evaluated their risks, they've looked at the fundamentals and the opportunities, and they've now done a partnering outreach as an investment.
Right. And I think, you know, when we talk about the reporting, the performance, and then the results, I think that they do an excellent job. So they just released their new sustainability report. I recommend going through it. It's very easy. It goes at that top level of the maturity. So they're about not just reporting everything, but telling their narrative and also talking about their targets. When we first looked at them, we said, okay, well, maybe they just outsourced all of their carbon footprint and all their water by setting up these bottling companies. But no, they reject. They actually take that into account in terms of their footprint, and they take that as a responsibility, as an accountability to help all of those subsidiaries also manage to the best of their ability.
Absolutely.
So they see the supply chain and the throughput. UPS, United Parcel Service, you know, logistics. They are a leader by every definition in terms of sustainability reporting and performance. And whether you agree with it or not, we see the data, and they believe in ultra transparency. And at the same time, I think they have some humility to say, yes, we report everything, but it's not enough. And just because we report, we're looking at new ways to analyze that information to improve how we manage our capital and how we can produce financial performance and shareholder value. And what leaders do is if there's a metric that's really important to them but it's not there, they will develop it. And that's one example of what UPS has done. So they're actually looking to track the energy intensity by each one of the packages, which I thought was a really interesting example of innovation.
It is an
What's your
innovation.
thoughts on that, Mark?
Well, it's an opportunity to assess the data relative to the different products they have in the marketplace, and they're a logistics company, so their business model is about transportation. So those analytics around use of their business platform and the customer end use of the product enables them to get that lagging indicator perspective,
right,
and looking forward around those leading indicators, and they can do the what-if scenario planning to do the product innovation. It's a significant opportunity for their investment. That they're creating their own metrics that matter, which we'll talk about later on with Carol.
Right. So, social. What's going on in social?
Well, social performance. You know, I had a chance last week. I attended the Sustainable Brands Conference in San Diego, and props to a successful conference for the organizers. And as I mentioned earlier, the CNN executives were there, and they presented their Freedom Project story about global child slavery. And in a sidebar discussion, we talked about the fundamental issues around what they see. And CNN charted this project to daylight these issues, which relevant to the ESG we talk about. It's about labor and supply chain risk.
Oh, absolutely.
Right. But one of the things they mentioned was that while we talk heavily about climate risk and carbon and environmental footprint, social performance and labor issues are really under the radar in the marketplace.
You know, it's interesting you say that because I've heard that a lot from the investment community. Like, how do we really measure social performance? Because some of the issues are only material to that industry. So there's not the universal ones. Yes, you can look at the diversity of management. You can look at they have a human rights policy, if they did the check the box this and the check the box that. But what are the most material social performance risks when you have a big, say, oil company or mining company?
Well, there's a number of social risks around investment in indigenous peoples, local community development. That shared value term you hear often is about the capital investments and how the companies themselves bring their own human capital and resources to bear in a particular community in which they operate, but they also partner with the local resources, i.e. the professionals, the technology services companies. But what I'd like to bring it back to is you think about some of the structural investment and the issues around the labor issues for the CNN project, right? They're talking about this, and they had mentioned one of the projects was the cocoa project, and the cocoa industry, which is 75% of global cocoa production is in West Africa, right? And the majority in the last 10 years, now the majority of that production and labor has been child labor. So those children are aggregated into what is global slavery production. Now, if you're a corporation, and there are many corporations that have been, there's top 10 producers that comprise about 80% of the market cap in this space. There's Mars, there's Hershey, there's several others, Nestle. Those companies have now, through stakeholder engagement, if you would, have committed to onboarding certain protocols and improving their operations.
Right. We're seeing more of that industry collaboration.
Exactly.
Right. We've talked about a little bit more with Carol. You know, that reminds me of one important story that came up a couple of months ago. It was for Hershey's, which you know, everyone knows Hershey's, Pennsylvania. They have a big theme park. But what hit the cover of the New York Times is the fact that they were using a third party for finding them labor. And in terms of finding them labor, they went to developing worlds and they found students to come under a work program. But that work program turned into basically a slave labor shop in Pennsylvania. Now, even though Hershey's isn't cutting them a paycheck, since they're putting Hershey's products in the boxes, and then they go and they're revolting and they're holding up signs about Hershey's, that would seem like a direct risk. Even though, like I said, it's not a paycheck, but it's so close to the supply chain and the product. So from an investment opportunity, you know, to me, that makes me nervous.
Well, let's bring that back. So we're connecting the dots here again. We're talking about ESG. This is the social performance indicator, right? This is labor standards, human rights, fundamentals. And you would think that reporting aspect back to the operating parameters of the company, this is fundamental to the supply and demand side of your business model. On the supply side, the human capital is your labor source for production. So your forecast production environment, right, is based on that premise.
Right.
It's based on slavery as a trade source. You've got risk to operations. That's economic sustainability 101. Now, on the demand side, you've got a customer basis that if they are aware of this opportunity and they make the decision, there's a revenue risk on the demand side because customers are now boycotting your product.
Right.
Fundamentals.
And we've seen that over and over again. So let's talk about the last segment, which is governance.
Yes, yes, indeed, governance.
So
Governance gone wrong.
Yeah, governance gone wrong. So we were talking about that the other night, and there's really no shortage of stories for governance gone wrong. But you know, when you have the CEO Jamie Dimon on the floor of the Senate Finance Committee explaining how, you know, why they lost $2 billion by the nickname the London Whale, and even though that he did know about it, they assured him that it was an aberration and that it couldn't happen again. And I have tremendous respect for Jamie Dimon and what he's done with J.P. Morgan Chase to weather the storm. So, but the fact remains is that without the proper, you know, basic checks and balances in there, and not being able to connect or be able to thwart the stop-loss gap, like why can't we stop it at 100 million? Why can't we stop it at $1 billion? Why did it have to get to $2 billion loss before we're finding out about this? It comes down to really basic governance and stopgaps in there. What are your thoughts on that?
It does indeed, and at a fundamental in the operating sense, it's about management systems. It's also about culture. It's about establishing that leadership framework. So there's an opportunity, and there's, as we mentioned, there's no shortage of governance gaps in execution. So let's look at another example in the energy business. Just recently, Chesapeake Energy, a oil and gas development company, both the CEO and some of the directors of the board, who actually just last week were voted off for their governance lapse, issues around the CEO taking equity position and borrowing capital against corporation assets for his private portfolio. That has been a fundamental issue. And again, another example of how they have the impact of that. Loss of market share, loss of capital position, a number of impacts.
All right, just for a second, going back to J.P. Morgan, I think they lost $30 billion in market cap, 19% stock slide. Chesapeake, the same thing. So again, that's why as an investor, we want to be able to take all those factors into account. So
absolutely,
could go on for an hour here more, but
indeed.
Let's move on.
Let's move on to our next segment, and what we're going to do now is invite our Q&A session, our question and answer with Carol Singer. I'd like to invite Carol Singer to the show. Carol.
Hi, guys.
Good morning.
Good morning.
Good morning.
Welcome.
Love being here in Denver.
Thank you for coming in. So welcome. You know, and Carol, we're so glad you're on the show today. You know, we mentioned at the outset that our purpose of this show is communicating the sustainable development investments and how companies are charting their course on sustainability, how they're making those investments in their operations, and how they're reporting, how they measure, manage, and communicate. And with your leadership, if you would, in a minute here, just tell us about NAEM and how you're representing the industry relative to the EHS and sustainability executives.
Sure. NAEM is the National Association for Environmental Management, and we're the largest professional association in North America, composed of the corporate decision makers of environment, health and safety, and sustainability. And we work to empower our members to really improve their conditions in their companies.
That's great, Carol. You know, we run into each other all the time at events, right? And just about every event. And you know, one time you said this statement, and it really resonated with me. You said that you kind of see yourself as the voice of EHS sustainability professionals. And you know, on our show and with this medium, what does the voice have to say?
Well, thank you for that introduction. You know, leading companies in North America really are doing a great job of advancing corporate compliance, ensuring safe and healthy workplaces on a global scale, as well as trying to meet the needs of sustainability in the new paradigm. So what we see is leading companies at all levels, including the CEO, are focused on what the energy performance of their companies, how they reduce waste, how they see themselves in a broader footprint of society, and then working to understand what sustainability means with respect to their own companies and to create new value opportunities.
And so much more. So, you know, I just remember that Mark and I met at an NAEM event.
We did.
Awesome.
So you were a driver behind everything that's going on here. So thank you for that.
Connecting is good.
Connecting the dots, right?
Indeed.
So I was down there and Mark was participating. I spoke on the green metrics that matter from the CRDA view, and that was over almost about a year ago, or a little bit over a year ago today. And you know, one of the things that we have really loved to see is this report take on a new life. So the green metrics that matter, there was research done, and then you put out a report, and then you put out, you worked with some other folks to put out a webinar to explain the findings of that. And everything is available on the NAEM website, and we'll be handing this out to the audience as well as to the executive roundtable. There's so many findings in there that I can't go through all of them. But let's talk about a couple. And one of the ones that really resonated with me, and what Mark and I really love to talk about, is bridging the gap. So, and this is kind of proof positive. So the way that corporations are rolling up their information, the way they're presenting it, the way they're communicating it, may not be the exact same way that ESG researchers and investment analysts like myself, as well as as we talked about before, the big investment and financial services company, actually want to process that information. Or it's not the way that they use it to make big investment decisions. So in terms of bridging that gap, what do you think is next, or what are the what do your membership want to say about that? Like, how are they going to help close that gap?
Well, thank you for those nice words about the Green Metrics That Matter. The Green Metrics That Matter was a survey that we launched with our leadership companies. And what we did was we wanted to take a look at what companies were actually reporting and how they were managing against those metrics. And what we found was that companies are doing a great job of tracking key performance indicators in the traditional areas of environmental performance, worker safety, health-related issues, some of the other social conditions. But there's not a great deal of established metrics, in the sustainability area. What we saw was that over 60% of the CEOs that we surveyed actually got real data on their energy, water, and natural resource performance. That's huge. You would not have seen that type of condition maybe 10 or 20 years ago. On the other hand, sustainability performance and how you evaluate a company is almost a different lens. You have the basic areas of material use, operational efficiency, but you also have to look at your whole entire company through a different lens. Until now, we've really looked at the performance of a company strictly through performance criteria. And sustainability is a way to look at the performance of a company with the traditional environment, health, safety, social, and governance criteria as well. So that's why the Green Metrics That Matter was good. We see that there is a lot of commonality, so that there are areas where both sides are looking at similar context.
Yeah, right. Absolutely. To add to that, it's a great contribution to the thought leadership that's underway in the marketplace. Today we talked about some of the news items we had. Look at the SASB, look at the other frameworks, look at the mainstreaming of the SRI community. So at some point, we may have already reached that tipping point because the mainstream investors are actually capitalizing on these opportunities. Right. So, I was curious though, is there some feedback from that investment and that analysis? You mentioned that EHS organizations, so there's a company, the EHS function, if you would, environment, health, safety, the compliance mandates are underway, they're somewhat mature. We're charting this course towards sustainability. You mentioned the different lens, and that's where the sustainability lens looks at every function of a company, right? And so what are you seeing as how companies might be collaborating? What are some top ideas you're generating from your membership around how companies are collaborating to invest in sustainability?
Well, that's a very good insight. Collaboration actually is the key word. If you operated in companies, you know that there are challenges in terms of ensuring compliance excellence or just excellence in your own areas. Most companies are vertically oriented, and sustainability really requires a cross fertilization. So what we see with companies is they're putting together cross teams that are collaborating. These teams can come from the environment, health, safety function, but they bring on new product development, they bring on research and development, they look at operations and manufacturing, they bring in marketing, sales, and procurement or purchasing. So it's requiring a very different approach, which is a horizontal approach to decision making.
Right. Now we all know the metrics that matter, right? We think we do.
We think we do.
But what we are seeing and what we love is at the events that you do, we get to meet the sustainability executives and we get to hear the narrative. So when we met James Van Lagen from Carnival, to hear what they're actually doing at Carnival was literally not captured in all the data. Because it's talking about the performance, but as an investment analyst, we've really tried to progress the way we evaluate companies. That's why we're working with leading performance indicators, where companies get to tell their ROI story. And it challenges them to do that. And also, we've interviewed numerous executives for articles that we work on. And when you pose that tough question, and they have to think through it, and then they have to articulate it, whether they write it down or they're doing it on the spot, we've been really impressed. And we think that the metrics that matter are phenomenal, but they're that starting point. And then that next generation is the narrative, the leading indicators, and having them tell their story, and having the excitement in their voice, because they're proud of what they're doing, and they're working really, really hard at it.
Well, I think that's a very key insight. You know, from my perspective, companies are really good at identifying a goal, developing performance metrics, then implementing that structure.
Right.
So they have strong process, they have strong focus, and they have strong measurements. And that's traditionally how companies were evaluated, through that very narrow context. And the more data you have seems to believe that you could have better decision making.
Right.
With sustainability, because it's requiring a different lens, the context is very important. So understanding what sustainability means to one industry sector may not be the same with a different. So for extractive industries that you mentioned, the evaluation or the critical sustainability elements are not the same as UPS or service company.
Right.
So it's important for companies to go internal to understand what is it that they do well, what is that risk in terms of financial risk, whether it's climate change adaptation, access to raw materials, reduce water usage in the case of CocaCola, and then really to focus like a laser on those issues and improve performance.
And link it back to the financials. You know, the Puma story recently with their environmental P&L, they took and monetized their carbon footprint, and they looked at it as a production environment issue. You mentioned earlier about Vulcan, and look at Bank of America. They've done operational investments in their own asset base, but now they're taking their principles for responsible investment, some of those institutional frameworks that they've adopted voluntarily, I might add, but then that's informing how they steward and lend capital. So they're taking what they've adopted in their own operating parameters and then saying, this is how we're going to lend capital and be the enabler for sustainable development. That's the pull-through strategy you see on the financial side.
Yeah, the challenge with Wall Street is that all data measurements by nature are lagging indicators.
Yes.
It's very difficult to have leading indicators. So historically, we've looked at management elements. Do they have management systems in place? For environment, health, and safety, an analogy would be, do you have corrective action, and you know, do you have audit systems? You know, something could be said about that. We had an incident recently with BP where they had those systems in place, but maybe not the corrective actions.
Right.
So it's a more holistic view, and many times that holistic view is you cannot derive just from numbers.
Absolutely.
So that's why context is important for sustainability.
And it's an evolution. So in the companies that do adapt and are able to evolve to these changing systems. When we showed some of the earlier information on SASB, and you saw the jigsaw puzzle, does that worry your membership? Do they like, oh my God, not another survey? And that's not what they do. It's a ratings guideline. But does that weigh heavily? Because these are some of the folks that have to either gather the information or produce the reports.
Well, thank you for saying that. You know, in the NAEM's Green Metrics That Matter survey, many folks don't know about the environment, health, safety, or sustainability officer in the company. But that research demonstrated that our members participate in 90% of the time in doing that analysis and providing that information, and in 70% of the time, they're in fact the leader for the company. So our folks are intricately involved in understanding what transparency and corporate reporting is. That said, I think we're really at the beginning. You know, it's while reporting and transparency has been going on for a couple of decades, as you said earlier, we really are at a very fundamental start, really, in what transparency and reporting means, because it's consistent with this paradigm shift. What I believe is that we'll go through a period where there'll be continued surveys and a lot more folks asking questions, but at the end of the day, there'll be fewer and fewer metrics that really matter. Because the context is such a large part, that you can only have fewer that are really critical in terms of key
Sure.
risk management.
Well,
Right.
Michael, think forward. I mean, three to four, maybe 2 to 3 years downstream, when the institutional frameworks, the SASB, IIRC, the GRI, there's a convergence globally. And that links back to, say, the XBRL reporting aspects and the SASB model, right? So there's an opportunity
Which we've
there.
talked about from the beginning of the show, when we were talking about real predictive stuff. And even at your conference, you know, we paint this picture of what's it going to look like. Well, we're going to work it all out. You're going to have one overall arching framework. You're going to have the metrics. You're going to have the industry working groups designing what the most material issues are for the industry. You'll be able to add in your narrative. You'll be able to put it all into a technology system by, like, maybe one of our partners, Enablon.
Perhaps.
And you can put all your data into that one overall software platform, click a button, and get this report of saying, this is what you're doing right, this is what you're doing wrong, here's where you need to fix it, and oh, by the way, here's what your peers are doing. So now you get that benchmarking, and you're finding out with a real incentive what you need to do. On the flip side of that, what if investors can go and say, well, tell me all the companies that have these characteristics?
Wow.
They can produce their own reports, so now they're using the information in a smart, intelligent, proactive way,
Yes.
right? And you're combining it all together. That's the future, not tomorrow, but maybe, you know, a couple years from now.
Well, I do think that information management systems are empowering a lot of information, and it is going to drive decisions. That said, I don't know what tomorrow will look like, but what I do know is that there will always be a lot of different types of surveys.
Sure.
Because different stakeholders have different concerns.
But we need to prioritize them.
And
Which one's the most
right.
material to
So
you?
a few years ago, you know, you would look at the landscape and it would have been very different than it is today. You talked about,
Sparse?
yeah, you talked about GRI, and GRI in the last couple of years has done a great job in terms of improving awareness of themselves in the U.S. and understanding. But one of the challenges in our field is to not only look at U.S. and European companies, but then to take a look at the broader global landscape. So one of the challenges I think that we'll be talking about in the future is whether or not the questions that we're asking today are relevant not only for U.S. or European companies, but also for companies that come from the developing countries.
Absolutely.
That's where
Yeah.
most of the asset value creation is coming from. And so really, those are the bigger questions that will be on the horizon.
Wonderful. So will you stay with us and take some of the questions and answers
Sure.
that we've been collecting throughout the past couple of days, as well as live?
Sure.
Fantastic.
Great,
Okay.
thank you.
So just to remind everyone, let's put the Twitter screen up there. So you can join us live by using the hashtag SDROI. At this point, we've compiled all the questions, and we'll answer as many as we can. But Mark and I will also be able to answer them over the next couple of business days, and we'll use the same hashtag so everyone can search it. But we're pleased to have Professor Dr. Dan Sweeney back with us to help us with this Q&A.
Well, hi guys, nice job so far. Carol, nice to see you. Look forward to a little interrogation for you here. And we've gotten a lot of inquiries from the audience out there in Cyberland, and let's start with one for you guys. And here's what the questioner says. I'm a sustainability executive, and I'm overwhelmed with the questionnaires and surveys. Could you elaborate on SASB and its value? And is this yet another survey questionnaire I have to fill out? Now first, Mark and Michael, for all of our audience members, we might explain what SASB is.
Sure. You want to recap on that? And then
Sure.
we'll-
Yeah, so just to recap for our members, SASB is the Sustainability Accounting Standards Board. It is a sister organization to FASB, the Financial Accounting Standards Board. FASB is the SEC sister company that's been chartered to develop the generally accepted accounting principles, GAAP, if you would, for US-based operators. So here is now this, and they provide the guidance to SEC annual reports. So we think about linkage to environment, social governance reporting. So the SASB is going to provide guidance on ESG foundational issues, what's material to be reported on the annual SEC report.
Right. And it's going to be through an investor lens, mainly, but using all the executives and the advisory board and the working groups with the thought leaders that can help them to develop what those guidelines are. So it's not another survey, but it's more of a framework, it's guidance, which is sorely needed, but from both perspectives, the investment community lens as well as all of the executive and the corporate community as well.
And they will have industry-specific protocols as well. That's what we think is very interesting.
Well, I think our questioner is probably greatly relieved it doesn't have to fill out another questionnaire.
Right.
Carol, here's one for you. You mentioned that NAEM is the, quote, voice, end quote, of the EHS and sustainability professionals. In your experience and research, what's the #1 recommendation for advancing the business case for sustainability?
Wow, what a great question. So I don't know if there's a #1, but I'd like to say that there are two approaches. One is an internal approach, and the second is an external approach that you can make in your company. So the internal one is really looking at your core issues. So looking at improving energy efficiency, water efficiency, natural resource efficiency, reducing less that's coming in. So looking for alternatives, and so that you have, so you may not have the same type of exposure. Looking for opportunities to create a marketplace for something you already have. So you have energy efficiency, reduction of use, and working internally to create those opportunities and engaging your employees. Many employees have a great opportunity to change the footprint of a company's company. Externally, look to collaborate with purchasing and procurement, R&D, marketing and sales. There's an increasing driver for sustainability, and the #1 driver, according to our research, is the customer. So quite frankly, engage those parts of your companies to understand what your customers and your suppliers want, and then create strategies to help meet those needs. And it'll help ensure a better relationship with those customers.
Terrific.
Well said.
Very helpful.
Indeed.
This is a free-for-all. No, it's not. It's for you guys. In the Truth in Performance segment, you guys covered a lot of interesting material in a short time. Could you please recap on a few of the hottest companies or sectors you would recommend?
Sure. So just to clarify, we don't want to be the Jim Cramer show. He does it already. He does it really well, better than us. So happy to talk about sectors and trends. Don't want to give individual stock advice, but in terms of what my perspective, and then maybe Carol and Mark, you could jump in. In terms of my perspective, I'm really bullish on industrial and manufacturing. So companies that are making things, infrastructure in terms of the roads that are going to be built, all the water that needs to be replaced. Companies that are working with utilities to make them, on both their demand and supply side, more efficient. So again, I'm, especially maybe it's because I just was in the heartland. So I think, being able to feed everybody, being able to transport them and provide them with energy. So I love high tech, I love clean tech, and I think that the sexiest part are the companies that actually make products that are going to drive this new economy.
Mark, what do you think?
Well, I think with what sustainability drives is regional development. We're on the cusp here with this new energy paradigm in the U.S., for instance, with natural gas. That could foster what could be the third industrial revolution. So you may see global operators based here in the U.S., like your membership, but who may bring production back to the U.S. soils because of energy footprint. So from the analysis perspective, companies look at hedge pricing on procurement aspects for energy consumption, energy materials and water. So I would say the multiple infrastructure. I would concur with your suggestion on financials.
So we're going to have to, I guess, carry this conversation more online. So we're happy to answer more questions using the hashtag #SDROI. I think that we never have enough time for Q&A.
No.
We just don't. So one quick thing that I forgot to mention that I promised I would do is that our partner Enablon is producing their annual conference that both Mark and I will be attending. Hope to see you there, Carol. So you can go to enablon.com and look at their event, their U.S. annual conference that will be coming up in September. So, and we'll also tweet that out as well. So Dan, take us home.
Take us home. Okay. Well, first, thank you guys very much for a terrific show. Lots of keen insights, good news, great analysis. And Carol, thank you very much for traveling here to Denver. Not quite the heartland, Michael, but a little further west. And for your really insightful participation. We appreciate it very much. Remember that our next analyst call will be held on September 13th. live and in person once again. For more information on these quarterly analyst calls, or if you want to provide us some feedback, or you want to post an observation that you'd like some comments on, the website is www.thechangingesglandscape.com. So I'm Dan Sweeney, and I want to thank you again for participating, and we look forward to seeing you again here in September.